Hello everyone, a very warm welcome to Market Insight. Trading members or the stockbroker firms plays a major role in the Colombo Stock Exchange, facilitating share trading, providing investment advisory, conducting research on the market movements, and educating the investment community are some of the most important services provided by the stockbroker firms. Today we have the privilege of having the managing director of one of the leading stockbroker companies in the country, Mr. Tushan Wickramasinghe. Tushan is also the managing director of Capital Trust Securities. Tushan, welcome to Market Insight.
Thank you for inviting me.
Tushan, to start off the conversation, we heard that your stockbroker firm has ranked the #1 in terms of the first quarter of current financial year when it comes to the turnover. And who are the owners of Capital Trust Group, and how did all this begin? Give us a little background.
Well, this all began in 2003 when Ishara Nanayakar and myself bought the smallest stockbroking firm at that time, DSA First Capital Securities, and within 6 months in a highly competitive marketplace, we were able to be ranked #1 in terms of turnover. And thereafter, just after the war, they sold out, and Mr. Rusi Captain and Mr. Raj Ratnam bought graciously 20%. And after some time, Mr. Raj Ratnam sold out. And today I have 80% and Mr. Rusi Captain has 20%. And they inspired me in how to invest in a long-term basis in the market, and to take quick decisions and be very ethical. Yes.
Okay. And most importantly, what I see different in Capital Trust is that it is owned privately, and it doesn't have a backing of or support of an institution like many other stockbroker companies. So what inspires you to come into this business and grow this business into this level?
Well, you must also understand the 3 shareholders I have had are in turn strategic investors and owners of institutions. So I had something more than the backing of institutions. However, it was they gave me a free hand to run the company the way I want. They never interfered, and I in turn, because of that, never went to them asking for any additional capital. If there was a requirement of any additional capital, I would personally go and put it. For example, there were instances to sustain a large debtors portfolio. I did it myself, and so it went on well. But I must also thank my employees who appreciated my vision, who backed me, supported me right throughout. And our firm is a firm where there is absolutely no internal politics. Everything is democratically decided and transparent. And although we started as a stockbroking firm, we created a holding company which has 34 subsidiaries.
Yes. 34 subsidiaries?
Yes.
So what are the areas you are into in Capital Trust other than the stockbrokering?
Yes, actually it all started in 2015 where I had to diversify into other areas, because I realized with the coalition government there are like many kingdoms, and there will be policy making differences, and I also thought that there will be, and it was correct, there will be higher taxation, higher interest rates, and in dollar terms, if we stuck onto stockbroking and investment in shares, we would have lost more than half of our capital. Therefore, we decided to drastically reduce our exposure into capital markets and we went into other areas. We created Capital Trust Properties, which is a property broking company with Colliers, Knight Frank, CBRE, foreign tie-ups. Then we have Capital Trust Residencies, which went into property development. It developed 3 apartment complexes and finished, and it has bought another 5 lands to develop apartments. Then we also have various Capital Trust Properties Group companies which have bought about 40 lands. Then we also have Capital Trust Technologies, which is into various types of technology companies. Then we also have ALFT Packaging, which is the largest flexible packaging company at the moment in the country. I also forgot from 2010 we have all the other financial sector companies like Capital Trust Credit, Margin Trading, then Capital Trust Wealth Management, licensed wealth management company, Capital Trust Partners, corporate finance company, Capital Trust Global Markets, a company which provides a platform to trade in 37 exchanges, and we do our own business, keeping a low key.
Oh, that's a very impressive portfolio of businesses. So, Tushan, focusing mainly on the stock market, that we found that you were not really focusing on the stock market during the period of 2015 to 2020 or so, and then you re-emerged towards the end of 2020. So, what were you doing at this period? Was it about other businesses, or what's the reason?
Yes, we correctly identified, and I must say that it's on record, that while all other stockbroking firms continue to do only stockbroking, we drastically reduced our exposure after being one of the leading stockbroking firms. We reduced our exposure into capital markets, and we went in a big way into property broking, and today we are the largest property broking company. And also we had a large property portfolio which we still have, and we started trading wherever possible, and actually mainly due to us, we created a massive rally in property in Colombo, especially in large lands where the prices went up more than 200% during the period 2015 to 2017. And also we created a big wave in apartment building, where many people followed us and started properties. But what we did was, what we started, the 3 we started, we completed. And 2018-19 we had a pause. We did not go into the other 5 projects which we had got approval, and while many others continued and got into difficulty. Then also what everyone must realize is that capital markets is not always good. It has its good and bad periods. So we have a separate sector, the properties. When the stock market slows down, the property market takes on. And also if both get stuck, we have a platform where we can trade 37 markets, but of course the investors have to have their own foreign exchange.
So that's the diversification you have been working on. And Tushan, if I take your attention into the stock market, the Colombo stock market per se, the recent digitalization process that has been taking place, it was a resounding success. And how do you think this initiative has changed the dynamics for the Colombo Stock Exchange? What are the changes you see?
Actually, it's a sad thing. This digitalization should have happened way back in 1998. But it happened after 25 years. And I have been a person who has been lobbying with the stock exchange, saying, a simple thing like make it mandatory that a stockbroking firm sends a email with the contract notes, and in turn the investor should give an email address. And that is how it was shown to us when we went to India in 2008, where there were small internet kiosks outside stockbroking firms where the prospective investor first comes and opens a internet trading account, internet account, and then they goes to the broking firm and opens a internet trading account. However, there were certain mysterious reasons, and I sometimes feel certain people did not want retail trading to go off. Some people wanted client complaints to cultivate, and there were certain political reasons why digitalization did not happen for 25 years. But however, correctly, this time the SEC commissioners decided not to open the stock market when majority of the local individuals can't trade without everything set up, without contract notes being digitalized, without broking firms being ready to transfer funds, and they set up a joint committee of the SEC and the stock exchange, and that committee very correctly, speedily took the necessary steps. So now if you see the advantages, earlier the whole system was inefficient. The clients had to wait for a contract note to come by post or to be delivered. Then the broking firm in turn got hampered because the client could always turn around and say, I did not get the contract note, and delay his payment. And the best part is when a particular government came, they even went to the extent of looking at transactions 6 years before, and the client comes and says, I never got contract notes. And how do you prove that a contract note was sent? You can't prove it. You'll have to interview the postman. I mean, it was a simple thing. Then the rule was that you may send contract notes by email. Then everyone takes that loophole and purposely does not give an email address. So what happened is this set of commissioners correctly came and said, you have to give an email address so that the broking firm can send the contract notes by email, and end of the month the CDS, being an independent party, can send the CDS statement. Then secondly, the clients are expected to give the mobile number. So when you give the mobile number to the CDS through Form 28 or through eConnect, then what happens is you get a SMS. Then the client is secure that he knows exactly what happened in the CDS account, and the broking firm is secured. They can't get a complaint after 6 years saying, I didn't know what happened in the broking, in my CDS account. Then the next point is, even if there is lockdowns, life has to go on. So now what has happened is, it has been the Securities Exchange Commission has requested to give their bank account numbers to the CDS. So therefore, dividends automatically go to the respective person, and accounts are 100% accurate. And further, because the bank details are given, the broking firms on settlement date, within half an hour they can transfer the money, and the clients in turn can transfer the money back. So things are absolutely efficient now. Now the next phase is where after already with the CSC app, you can open accounts through the app, and there is a resounding success in it. More than 90% of the accounts now happen through the CSC app. The next phase is where the diaspora in foreign countries can open accounts through the app, and then also they are going to facilitate local companies to open through the app. Then there is a feature, new feature which is coming out this week, which is eConnect, where the clients can go to the app and change their details as and when they want. So it's such simple things which have not happened for 25 years, and immediately you can see the market is going to the provinces, and it is fast becoming a proper market. A proper market means where there is, according to the economic books, where there is millions of buyers and sellers, right? And then there's proper price discovery. No one can manipulate. That is, we are heading towards that. Earlier we did not have a market. It was just a set of people just doing passing the parcel. Okay.
Okay, great. So now at least we are there. So let's take a quick break and join again with Market Insight. Welcome back. You are with Market Insight, and we are with the conversation with Mr. Tushan Wickramasinghe, the Managing Director of Capital Trust Securities. Tushan, now we were just talking about the digitalization process, and not only that, now Stock Exchange is planning on introducing several other initiatives such as delivery versus payment and short selling. So even these ones were there in the discussion for some time. But what is the change for investors with the introduction of DVP, the delivery versus payment? And also, do you think Sri Lankan market is matured enough to embrace these changes, especially something like short selling?
Well, if you continuously say that a baby is not matured and keep him at home, he'll never get matured. In the same way, if we say that the market is not matured and there are risks involved, the market is never going to get matured. You need to quickly do what is necessary, bring in the necessary products, and thereby the market will get mature, right? Then fires delivery versus payment, DVP. What this has been the requirement for the last 25 years again of various foreign funds, and we have not been able to go from being a frontier market to a emerging market, because DVP and central counterparty features were not there. So last 3 years there were more planning about it. Last 1 year there was meticulous planning, and finally we are there to now to implement it. So there is some undue excitement with investment advisors and investors. I am the one actually at a CEO's meeting explained there is no change whatsoever. So basically, as far as the investors are concerned, they can delay in payments if they were habitually doing that. They can get official broker credit, they can get margin trading, they can pay and receive funds the way they are getting. They can buy and sell many times on the same day. Everything is the same for this investor is concerned. This is something which the investor need not know. This is something to do with the stockbroking firm's accounting division and the CDS. So for the stockbroking firm, actually when you look at my stockbroking firm, when we took the last few months figures and we tried to see how much more liquidity we need, I was surprised to see we need less liquidity deposit than earlier with the Colombo Stock Exchange. So there is no liquidity problem for the stockbroking firms. Therefore, then for the stockbroking firms, this is a very much more riskless system, because earlier what happened was that whether a client paid or not, every single stockbroking firm settled the CDS on T+3 9A. Now what's going to happen is on T+3 9A, when the stockbroking firm pays only, they get the shares from the other stockbroking firm. But far as the client is concerned, there is no change. So it's just that the risk for the stockbroking firm per se is not there. And in certain WhatsApp messages which are going, they are talking of buyer and seller. It's not buyer and seller, it's a buying broking firm and the selling broking firm. It's something to do with them. And so we are very happy that finally after 25 years this is happening, and it has no impact whatsoever for the individual investors.
And also, Tushan, Capital Trust was the first stockbrokering company to introduce technical analysis in Sri Lanka. If I'm not mistaken, Mr. Sarath Rajapaksa, one of the former directors of Capital Trust Group, is considered as the father of technical analysis. And now today, it is being used heavily among the investor community. And what are your thoughts and views about this wide interest of technical analysis among the investors in the current context?
Yes, so firstly, Mr. Sarath Rajapaksa is my father-in-law, and he has a passion of collecting master's degrees, and finally he was doing a PhD on technical analysis in a foreign university. So, so actually he knows everything about technical analysis, and I would say that is what you call authentic technical analysis. So what I am doing now is learning from what happened in 2010-2011 period. I am first getting the fundamental analysis division of Capital Trust Securities, which comprises of 8 analysts, to pick out the fundamentally sound stocks. I mean, on average, I would say stocks which are having a P ratio of less than P ratio of less than 7, price to book value of less than 1.2, then stocks which can withstand the depreciation of the rupee. Find that the basket of shares and give only that basket of shares to the technical division, headed by Mr. Rajapaksa and couple of other analysts. So then they exactly daily, they do daily charts, then they do hourly charts, and see how 7 technical tools change. Then at the proper time they come and say buy, right? Then further to that, I must say, we daily look at about 30 stocks, but the signals are not good, and we quietly keep them on a side, because I see that when we come out with many sell recommendations, the public who have those shares don't like it. So I must also confess we are doing like that, but we are doing with a difference. We are not going to do technical analysis on fundamentally weak shares. So this is about finding fundamentally strong shares and timing the proper buying time and exit.
Okay. So with this technical analysis side as well, so let me take your attention to this new generation of investors who are technically savvy and very well connected through social media, and now they are playing a increasingly bigger role in the stock market. And do you think this is a welcoming development, or can it be detrimental to this fundamentally driven stock market?
Actually, historically 1985 to 1991 period, people used to take certificates and go. Then you find people coming and meeting a stockbroker or phoning and placing orders. But now everything is done digitally, and that is going to help to propagate stockbroking very fast. So actually, it's a welcome thing that social media is there to propagate stock market. But as you know, media is media. You can use media for good purposes and bad purposes. But the public should know to be mature enough, not like fools to just follow something what somebody is saying, to grasp what is being told, see what happens by following somebody, and then see what to follow and what not to follow. So basically, overall, social media is a very good thing, and it should not be killed. It should be allowed to go on. But I, appeal to the investing public. It's better if you can go to licensed stockbroking firms, social medias, webinar channels, and of course you all can go to Capital Trust Research YouTube channel, which has various YouTube webinars which are very educative. And if you go to a regulated stockbroking company, there is a recourse. If something is wrong, you could complain to the SEC, right? However, but if you go to listen to each and every one in some WhatsApp group, what generally happens is people who want to sell something is promoting a stock. When somebody has sold a share, he starts talking all bad things about the share. So the investing public must be mature enough to understand how to gauge posts.
Okay, Capital Trust is also involved in real estate heavily. CSC has recently introduced this new product connected to real estate named REITs. And what are your thoughts about this new product and how Capital Trust would take the benefit out of this particular product?
Yes, so okay, Capital Trust Properties is, I would say, very qualified to launch REITs, because painstakingly we have been developing a large property clientele. That we have about 5,300 properties for sale, and silently many transactions are being done. We ourselves are investing so that we know the reality. It's not what is in books. And also Capital Trust Properties has tie-ups with Colliers, Knight Frank, CBRE and some others. About REITs. REITs are real estate investment trusts. So once again, I must commend the Securities Exchange Commission for quickly doing what is necessary, putting out the rules, and in the budget they pushed it, where the 4% stamp duty has been reduced to 0.75, but I'm not sure whether it's gazetted or not. But there are certain unfortunate practical issues. One is how the law is written, is that you need to have completed partly residing properties with income streams. Now the problem here is there is a bit of an unfortunate situation. If you take our stock market property sector, trades at a price to book value of 0.7. Then there are there's a well-known shopping mall, well-known towers which are trading at around 0.5 times price to book value. So then even if we set up a REIT, will there be a demand at one time price to book value? So there is a issue like that. But answering your question, Capital Trust Properties is conversant in setting up REITs, and it's a correct step in launching this product, but we need the proper time for it to materialize and be lucrative.
Okay, so it's a matter of time at
Yes.
the moment. Okay, so let's take a short break once again, and let's join again with Market Insight. Welcome back to Market Insight, and we are in the conversation with Mr. Tushan Wickramasinghe, the Managing Director of Capital Trust Securities. Tushan, for the stockbrokering company now, there's a huge untapped market even at the moment outside Colombo. And Capital Trust, we have seen that you have been in other parts of the country some time back with your branch network. However, we don't really see that you're trying to expand on your branch network, or maybe you're scaling down. Do you have other mechanisms to reach out to outside Colombo investors?
We have branches in Kandy, Matara, Kurunegala and Negombo for the last 15 years. One thing is that we cannot find graduates in other towns who are conversant in the stockbroking firm, as well as we know their background and we can trust. So that is one of the limitation factors. Then with technology, now what we find is that there is more than 20 million people having mobile phones, and I assume 10 million may be having smartphones, and it is easier to control from head office and put the proper research out, put the proper messages by WhatsApp, and communicating like that, so that because we want to be responsible for what we are saying and what eventually the customers are doing, right? I personally want to make sure that all customers don't listen even to a stockbroking firm, right? Stockbroker, the investment advisor. I want them to be empowered by themselves, learning everything from a stockbroking firm. What I mean is they must learn how to read a P&L balance sheet, learn what each ratio is. The stockbroking firm should weekly provide, now for example, Capital Trust Securities weekly provides the main ratios of 160 companies with the buy recommendations on few solid companies. At the same time, monthly we put 2 or 3 company reports. Then suitable sectors we put research reports like the tile sector, export sector, and we guide the investors what they should do. Then they don't need to listen to this rumor, that rumor, this blog site, so and so's WhatsApp group. All that is not necessary. Then the next issue is the timing. For that, we want to send our technical analysis updates, and those cannot be manipulated by anyone because it's the output of a Reuters Metastock system. So the authentic technical analysis goes out and it's no one's interpretation, everyone can transparently see. So what we prefer is from head office research division, empowering the investors to make their own decisions so that everything is very transparent. Technology is supporting, and actually COVID has helped stockbroking. Because of COVID only this digitalization initiative happened. Because of technology, there is far more smartphones, there is far more internet penetration, and if anyone says, okay, I don't know to transfer funds through my smartphone, or I don't know to use the internet, as a prominent person in the SEC said, let that 2% just be on a side. We will go in our part and take the market to the next level.
Okay. So, Tushan, now in the current context, the local institutions and foreign institutions, now for this year, from the beginning itself, they were kind of net sellers and staying out of the market. Can we sustain or go forward without these categories?
So the general belief is that for the Colombo stock market, there has to be foreign institutional buying and local institutional buying. But if you really go and take the facts, the last, if you take from January 2020 to date, there has been more than 75 billion foreign sales, right? That's massive. Then if you take the last 10 years also, there has been net foreign sales. So then if you take the local institutions, after 12th May 2020, you take the unit trusts, I think the funds are static and there is no net buying or selling overall for the equity markets. If you take the local institutions, except SLIC, others, I think there is a net outflow from the equity markets. So what I feel is, if local institutions are not sure what to do, best is that they do not do anything, right? Rather than being net sellers in a very lucrative time, right? And foreign institutions and local institutions not being is not a problem, because there is 7,000 billion fixed deposits, right? And every day is a maturity proceeds day, like the stockbroking settlement dates. Every day, finance companies and banks, there is maturity proceeds, funds going out. The stockbroking firms have to just take a tiny little bit to sustain an upward rally. And with this government's policy of keeping low interest rates, that will happen. Then you may say, okay, the interest rates may go up because there is a depreciation of rupee. Normally, when there is a depreciation of rupee, you increase the interest rates. But in the immediate present, even if you increase interest rates, foreign funds will not come to invest. So therefore, I believe that interest rates will be at the present level till at least March 22. And with the maturity proceeds of fixed deposits, the market will have a substantial rally, and we have to just keep the local institutions, foreign institutions on a side.
Okay, that's great. So, if I may ask now, you have mentioned several times about the digitalization process and this DVP. There is a lag of about 25 years. We have been waiting for these initiatives. But why has the stock market infrastructure and products not grown for the last 25 years? What was the issue?
That's a good question. So actually, when I started my career in 1991, they were just finishing the completion of the launching of the Central Depository System, CDS. And that was a big break, because before that people were running around with share certificates from company secretary to the company secretary, and the system couldn't go on anymore. Then there was this mad thing where you had to put a quotation in the board, that is what you call the open try system. And so there were some firms even going to the extent of having ruggerites to put their quotations. So that also was a absurd situation. So 1997 we had finally the stockbrokers calmly sitting at tables, and we had the automated trading system coming in. So it's exactly 25 years from 1997 till today. There's nothing significant happening. when I really think what significantly happened, I remember there was the launch of a day trading system. Then 5 licenses were given to primary dealers to trade in the day trading system. But far as I know, nothing happened. Then there was a McKinsey report which everyone was running around about for 1 year. I don't know whether anyone used it. And several $100 million, rupees got spent on that. So, so actually nothing happened, and actually I think it's the the capacity certain officials had and their political agendas have created our stock market to be at this present level. At least now I'm very happy. We had a short period, 2014 period, where there were 10 committees and a 10-point plan which was being implemented, but the government changed. Then from middle of last year, things are nicely working out, and we are catching up on 25 years.
So what were the challenges you encountered with the stock market for the last 10 years? But I believe you have 30 years of experience in the market. So if you look back, what were your challenges?
Yeah, my first challenge was when I was told in 2011 that the local individual and local company turnover level has gone up to about 89%, and majority in the SEC Secretariat feel that it's far too high and that has to be drastically brought down. And although I gave my comments, I was not listened to. And then at once SEC directive came saying to sell all debtors positions within 6 months, then they extend for another 3 months, etc. And basically that created a forced selling situation in the entire market, because if you had a debtors portfolio, you had to sell. People who did not have any debit balance had to sell. Broking firms, most of the broking firms, including our one, we had our own funds. With our own funds, we can do a capital reduction and go home and do anything what we wanted. But we can't give it to the most important component, the retail clients. We couldn't give that money to, and there was a artificial crash which was created of 33% in 2011 March starting. So that was the first hurdle, and actually our broking firm lost a lot in terms of bad debts in capital trust securities and capital trust credit. Then everything was fine in 2014. Everything was ready for we had a good year in 2014. Then 2015, with the government change, we found a regulator who came and said we need to do only market regulation and not market development. But if you go to the SEC objectives, you see in different words it says market regulation and market development. And then what is the future? So that was a challenge. Then, selling out large stock positions, telling investors to gradually reduce the exposure to shares, all that was a challenge. Then COVID came in March, April 2020. Then there were webinars saying blood on the street. Then majority were saying gloom and doom. Index will come to 3,800. GDP growth will be -5 and worse. we had to have webinars and say, no, market will immediately go up to 5,000 and thereafter further go up. And so end of the day, those recordings are there, what we told, and the market in one shot went up 107% by January. From 12th May 2020 to date, the market has gone up 85%, and we have been correct. So there have been many instances we are in the minority, but we are telling the correct thing. Even now, majority of the fund managers, majority of the research units tell to buy certain conglomerates, certain banks, right? But purely if you just take the prices and compare in the last 1 year, like we say from 1st of January 2021 to date, if you compare, certain shares have not gone anywhere or gone negative, while certain shares have gone 50 to 200%. And we are there going on record with research reports, webinars, what to buy, and you can just compare the prices and see what has happened. So that is also a challenge. We come with a particular doctrine which some don't want to understand because they have bought the wrong shares, and some don't understand. Like, the rupee will definitely depreciate, and you need to have dollarized assets and dollarized income shares. Yes.
So that's definitely a challenging journey. So we'll take a short break and join again with Market Insight. Welcome back to Market Insight, and today we are in the conversation with Mr. Tushan Wickramasinghe, the Managing Director of Capital Trust Securities. Tushan, let me take your attention to this, the Sri Lankan, the most rural areas and outside Colombo, the people lives there. They're more dominated by the fixed deposits and savings culture. That is part of our culture. And at the moment, the FD rates, I would say, would be less than 5%. But even at that level, if we compare the number of accounts, the bank accounts, with the number of CDS accounts, the number of CDS accounts would be insignificant. And why people still would prefer that 5% fixed deposit return compared to investing in the stock market? Where have we gone wrong?
Yes, interesting question. So, one thing is, certain governments, their policy was to have high interest rates so that the older folk get a good return. So, quite a lot of the periods, I mean, before 2010 period, the interest rates were very high due to the war. Then when you take 2018 November, even the prime lending rate was about 11.8. Deposit rates were in all finance companies were double digit. So it was very convenient to put the money, do nothing, and get a fixed return. So now there is a big issue for all these people. When I say these people, that is, there is 7 billion regulated fixed deposits in finance companies and banks, and maybe there is another 3 billion, I'm talking of 7,000 billion and 3,000 billion. The 3,000 billion unregulated fixed deposits which are there. All these people don't know what to do, and they little know that now the inflation rate is 5.2%. So therefore you get a negative real return now. Then after tax, the negative real return further increases. Answering your question, why hasn't the stock market gone up, propagated much more? It may be that certain stockbroking firms are owned by banks, and they may be doing things in a particular strategy. Then the customary banks and finance companies have massive advertising budgets, massive sales forces. Then you take even the insurance companies have massive sales forces, which the stockbroking firms never had. So although at present the stock market, purely you take the published information, the all share index has gone up 85% from the day the market opened after the lockdown on 12th May 2020. And the proper shares which we have been recommending have gone up 50 to 200%. So the stock market has to propagate much more, but however it's not happening because the owning companies or the stockbroking firms are also not aggressively marketing the stock market, but it will naturally get propagated.
So it's a matter of time.
Yes.
And as you correctly touched upon, Tushan, all share price index has gone up 85% from the May 2020. And with that increase, do you think, is it too late to invest now, or are we still not too late? What is your view on that?
Yeah, I have to reply you like this, and I think everyone should really understand this. Now, Capital Trust Securities had a webinar on market outlook, and all details are there in our Capital Trust Research YouTube channel. So the summary of it is that if you look at the market P ratio, we are at an all-time low market P ratio within Sri Lanka. In 2010, the market P ratio went to a very expensive level of even 29. Now the market P ratio is around 9. Then you take the price to book value, the last 4 years it's at a price to book value of approximately 1 time. And that also in turn is the lowest. Then people will say, okay, Sri Lanka has so much of problems, so therefore it is so cheap. Then we look at the regional peers. When you take all the countries around Sri Lanka and comparable to Sri Lanka, once again our market is the cheapest in terms of P ratios and price to book values. Then what is so special now? Why am I saying it's not too late? The last quarter ended 30th June 2021. We had, as I remember, the quarterly earnings of all quoted companies was about 111 billion. Then if you take the total comprehensive income, taking account revaluations and exchange fluctuation gains, then it was 135 billion. Those two figures are all-time high. So therefore, comparatively, you need to continue to buy. Then the next question comes, where do you see, I get really annoyed when people say, where do you see the market end of the year? Where do you see the index? Then somebody is drawing lines after lines in a graph and saying, this will happen to the market. No, market is a whole bunch of 280 companies. You don't look at the market. It has so many companies which are going the wrong way. Don't get misled looking at the all share index daily and deciding what to do. Look at the relevant companies which we have recommended, and buy only those particular companies and see how those groups of shares are doing well they will continue to do well over the next 2 to 3 years.
That's a great advice. And as you correctly mentioned, we have seen there was so many webinars and educating sessions conducted by Capital Trust recently through your YouTube channel, and there were Zoom sessions. So what is your objective with these initiatives?
Yes. So actually with the lockdowns, people, our clients were quite restless. So we wanted to, get that full energy and attention into the stock market. So our first webinar was on update on the tile sector. So the summary is that the tile sector is benefiting from import restrictions. Then the misconception comes, what happens when there is no import restrictions? Firstly, with the reserves being in a particular position, the import restrictions is going to be there for at least another 2 years. Then in the unlikely event within 2 years it is taken out, what happens is also gazetted. It is gazetted with the new duty rate and the cess rate, and with further depreciation of the rupee, the requirement of credit terms by the supplier. Because of those 4 factors, the importers will not be able to compete with the local produce. Local production also has developed. They are producing fantastic tiles, which are beyond the Italian and most of the Chinese tiles. So there is no need for anything to change there. So in short, the next 2 years, the same sort of profitability will be there, which means the P ratios are less than 7. Then thereafter, because of the certainty of gazetting, what happens when the import restrictions are taken out, the major 2 tile producing groups have decided on their expansion, and the expansion will kick in, and then they will start producing 95% of the production. And now what is happening is, people think construction industry will have a hit now. Even if it has a hit, it doesn't matter, because what happens is, what the local companies, the local tile companies are producing 52% are going to produce 100% or 95%. So their earnings are going to be always very good. So that was the first webinar. Then the second webinar was on, I'll go to the fourth webinar. Fourth webinar was on export sector picks, basically dollarized income stocks like, let me not name stocks, but there are dollarized income stocks which with normal growth they will make exponential profit, because what you can be sure is there's going to be a depreciation of the rupee. Right. Then the third category is we had a stock market outlook, where we told about depreciation of the rupee and why we should look at stocks which are depreciating. Stocks which are going to benefit because of the depreciating of the rupee. And so those stocks have already, there is actually one stock which has in last 6 months appreciated around 200%, and by just doing their normal operations and depreciation of the rupee, those stocks will appreciate. While certain people say certain things are one-off, but when you have many companies, many assets, there will be continuous selling and re-evaluations of those assets happening. Then another thing which we have told, which is connected to depreciation of the rupee, is when a foreigner comes with a certain amount of money, he will find that when he converts the dollars into rupees, he gets more rupees. Therefore, companies which have large amount of real estate gain by doing nothing. Because of the depreciation of the rupee, there will be revaluation, and when there is when the real estate prices go up, and then there is revaluation. But then we further explained, you need to take the other comprehensive income figure, because that includes the normal earnings plus exchange fluctuation gains and the revaluation. So far as we are concerned, we as investors, we should look at point to point, that is starting date till the ending date, the difference between the NAVs, and we don't care whether it is earnings, revaluations or exchange gains. We should look at our final net worth. And far as I'm concerned, I would prefer if high net worth individuals have share portfolios and buy and sell and not have to pay capital gains or any other tax, or buy and sell companies where they have to not to pay tax, rather than having a massive operation of large amount of employees, large amount of problems, and pay 24% tax if you are a finance company, 36% tax if you are a bank, 46% effective tax. So our philosophy is a bit different.
That's a lot of insight. And finally, the last but not the least, let me ask you, what is the final advice you would give to our listeners who are willing to invest in the market?
Firstly, I would tell investors to thoroughly understand what the basic ratios like P ratios, price to book value, and look at charts of past ratios, and thereby look at the future forecasted ratios, and they themselves should be able to decide what share is cheap, what share is not cheap. Then whether we like it or not, it will be a way of living to live with high inflation, which means that you need to have your money in real estate or shares with real estate. If not, your money is going to lose value by just having it in the form of cash, and cash is not king anymore. Cash in fixed deposits gives negative real returns, so please do not keep it in fixed instruments, because you are going to get negative real returns. Then what should one do? Because of COVID, certain stocks, because of their exporting businesses, because of basically glove manufacturers export. Then there is logistic companies which are making phenomenal profits. Those companies related to COVID you can buy, but those ones also shrewdly are going to make those normal profits even after COVID is going to finish. Then you need to buy especially companies with dollar assets, because anyone can say, okay, dollar is depreciating, buy dollars, but there is exchange control, you can't buy dollars. So therefore, what should you do? You should stay in Sri Lanka and buy companies which have shrewdly over the last 7-8 years who have gone and bought a large amount of dollars. So if not, you can't get dollar exposure. So if you have stocks with dollar exposure, I mean, you can sleep well, because you really benefit when the sure thing what happens, dollars, the rupee depreciating against the dollars. Then another one thing what I will tell you something which majority won't like, is that what we have found is that now majority of the investors feel borrowing is bad, it's dangerous. But I would say not borrowing is dangerous, because if you borrow now and take a, we'll say a 10-year loan, the first 5 years the home loan interest is 7%, thereafter PLR plus 1. Then in 10 years what you are going to give is maybe only about 40% of the purchasing power to that bank. You gain and the bank loses. In the same way, if you have perpetual margin trading and you invest in the proper stocks which I now mentioned, I purposely did not mention stock names, but I just mentioned stock categories. So then what happens if you borrow and go and do margin trading, then what happens is after 10 years you will find your net worth is far higher, while what the banks have got is as purchasing power far lesser. Then somebody will say, oh listen, I went margin trading and I lost money. No, the secret is, even though a bank or whatever broking firm gives you all 50% margin, please buy only up to 35%. There will be irrational movements by various types of investors which will depress prices in the most unexpected times. There can be natural disasters, there can be political disasters, all that. So you need to be able to withstand and go through that little bump. So you have to borrow, but please buy up to only 35%, and then you can maximize your wealth.
Thank you for that wonderful advice from the veteran itself. And thank you, Tushan, for being with us today, and we are truly privileged to have you, and thank you for sharing your veteran insight with Market Insight.
Okay, thank you very much.